Assalamualaikum and hello everyone. My name is Siti Hazwani and my friend Yumni will be presenting about Heckscher-Ohlin theory. First of all, let's start with the background of Heckscher-Ohlin theory. Heckscher-Ohlin theory was developed by two Swedish economists, Bertil Ohlin and his teacher, Eddie Philip Heckscher. The theory was developed in the year of 1919 because a written Swedish paper by Eddie Heckscher was found at the Stockholm School of Economics and Bertil Ohlin explored it in 1933. The purpose is to replace classical trade theory that only prioritized labor costs in producing goods. Previously, classical economists such as David Ricardo argue that comparative advantage depends by the differences in the labor cost since it is the only factor they recognized. They do not explain about the differences in relative goods prices. However, Heckscher and Ohlin argue that the production needs not only the worker, but it depends on other factors. The importance of Heckscher-Ohlin theory are balancing international trade between the two countries. It means that the total value of two countries' exports are equal. Second, this theory allows constant returns to scale. It means that the inputs and produce outputs are both increased in the same proportion. So, if the quantity of labor and capital used per time unit are both increased by 50%, 15% output would increase as same as 15%. This theory also allows two countries use the same technology, which means that producers in two countries will be able to use the same amount labor and capital in production of each commodity if factor prices are same. But different countries usually have different factor prices. So, there are producers that use different production factors which are relatively cheaper in their own countries to minimize the production costs. Not only that, this theory also shows that tastes of consumers are same in two countries. Tastes are equal in two countries in terms of demand preferences as in the shape and location of the indifference curves are same in both countries. So, what is definition of Heckscher-Ohlin theory? Heckscher-Ohlin theory can be defined as comparative advantage theory in international trade that prioritize its production factor such as workers, land, capital resources and whatnot, where countries that has large capital and limited labor will export capital-intensive products and import labor-intensive products, while countries with large labor and limited capital will export labor-intensive products and import capital-intensive products. So, what is comparative advantage? Comparative advantage is defined by an economy's ability to produce particular goods or services at a lower opportunity cost. In other words, a company with comparative advantage will be able to sell their goods and services at a lower prices. So, what about opportunity cost? Opportunity costs represent the potential benefits an individual, investor, or business fail to get when choosing one investment over another. That is why sales margins or profit ratios to show the sales percentage that has turned into profits in order to measure the company or a business activity that can earn money. So, sales margin will help an individual or business to make better decisions. Let's take a look at the example of comparative advantage. Assume two countries, Singapore and Malaysia. They both produce palm oils and egg. Their relative production levels are shown in the table below. For the Singapore, to produce 1 unit of palm oil, it has an opportunity cost of 4 eggs. However, for Malaysia, to produce 1 unit of palm oil, it has an opportunity cost of 1.5 eggs. Therefore, Malaysia has a comparative advantage in producing palm oil because it has a lower opportunity cost. Then the table shows Singapore has a comparative advantage in producing eggs. This is because it has a lower opportunity cost of 0.25 compared to Malaysia, 0.66. In this situation, if each country specializes in one good, then, assuming constant returns to scale, the output will double. Look at output after trade. The total output of both goods has increased, illustrating the potential gains from exploiting comparative advantage. By trading the palm oil, Singapore and Malaysia can enjoy higher good quantities.
Let's proceed with Heckscher-Ohlin model, but first of all, we need to clarify that this theory is relatable with international trade. Why do we trade? Because of difference in relative prices of different goods in different countries. Relative prices here refer to ratio of price. Heckscher-Ohlin model is also known as HO theory that focuses on the difference in the relative factor endowments and factor prices as the most important determinants of international trade. It is stated that the HO theory can be presented in the form of two theorems, the so-called HO theorem and the factor price equalization theorem. So here is the simple diagram of 2 by 2 by 2 model of HO theory to enhance your understanding. The 2 by 2 by 2 model each represents a different subject. The first two represents two nations. Example here we put United States and India. The second two represents two commodities. Example here wheat, which is goods produced by United States, and cotton, which is goods produced by India. And the last two represents factor endowments in this model, which is capital and labor. Some countries have more capital and some countries have more labor. Hence, this shows differences in factor endowments of two countries. To be exact, the countries that have more capitals, they tend to produce more capital-intensive goods, whereas the country that have more labors, they basically produce more labor-intensive goods and export them. Meanwhile, they import the less commodities from the countries that have more any of these factor endowments. Let's do some simple equation of inequalities, and we will be referring the 2 by 2 by 2 model. Alright. Let's say here we have two nations that being marked as A and B. Two factors of endowments, obviously the capital and labor, which K represents capital and L represents labor. Next, we have two goods of X and Y, which X represents the capital intensive goods, meanwhile Y represents labor intensive goods. To see how these inequalities work, we put some of the assumptions that Heckscher-Ohlin stated in this theory, which consists of 11 assumptions, but we are not going to go deeper to each of these assumptions. So we got perfect competition in both commodities and factor markets in both nations. Production function of two commodities have different factor intensities, constant returns to scale, and no transportation costs. So basically, based on these four assumptions, we will relate it with this inequality, which suppose that this inequality is true. If this happen, then it defines what? Okay, as you can see, K subscribes A is the total amount of capital endowment of a country A. Similarly, with L subscribes A signify the total amount of labor endowments in country A. This also define the same thing, but in country B. But what does the whole ratio telling us? It is telling us that capital labor ratio in country A is the amount of capital in country A per worker or unit of labor. In other words, how much capital there is per worker in the country. Similarly, with the ratio of capital labor in country B and the amount of capital in country B per worker. So if there is more capital in country A relative to labor, then we say that country A is relatively capital abundant country. Note that we are comparing the capital per worker or capital labor ratio in the two countries, not only the capital or labor. Hence, if this inequality is true, then it follows that this inequality is true. Since this ratio shows that there is more labor per capita in B compared to country A, therefore B is labor abundant country. Same method with this part. If this inequality true, therefore X is the relatively capital intensive goods and Y is the relative labor intensive goods. For example, here we put aircraft as the example of capital intensive goods as it needs more capital to produce. Meanwhile, furniture and bedding is the example of labor intensive goods which is need more labor power to produce it rather than capital. Next, we go through the factor price equalization theorem. To be short, this theory has been suggested and popularized by Paul Samuelson in 1948, which he contributes in the world of international trade and economy. This theorem deals with the effect of international trade on factor prices. As we look at the graphic here, this is to cut and short that before both nations engage any international trade, the wages of the workers in US is greater than the wages of workers in China. This is due to the US as the capital abundant country and China as the labor abundant country. And the form of real interest of freight also comply the differ results in which real interest of freight in China is greater than in US. Let's say, for example, both countries produce goods. US produces microchips and China produces toys. According to the picture, you can easily understand that you need less labor and more capital to produce microchips, whereas to produce toys, you need more labor but less capital, as we all know that toys production require only small amount of capital to begin with. And if we go back to the HO theory, obviously US will export microchip, which is their capital intensive goods, to China, and they will import toys which is labor intensive goods. Similarly to China, they will export their toys to United States and import microchip to their processing and manufacturing industry. So how this affect the factor price, that is the wages and real interest of rate in terms of capital. So we will go one by one and start with US. Okay, let's think that microchip production will go up where toys production will fall. If the production of microchip increase, so the demand of the labor also increase. But since to produce microchip only needs a small amount of labor, hence the demand of the labor will only increase for a little bit. On the other hand, the production of toys fall. It is going to free up and it is going to supply into the economy a lot of labor because toy production used a lot of labor. As a result, there will be increase in demand workers for US. Meanwhile, for China, it will be a lot of increase in worker supply. This is where a lot of questions appear in order to understand factor price better. Let's go one by one. Okay, now what happened if the demand increase a bit but the supply of workers increases by a whole lot more? In this case, the price of labor or wages will fall. Therefore, in US, wages is going to fall. Next, what is going to happen in the capital factor market? When the production of microchip goes up, the demand for capital is going to go up by quite a bit because microchips are capital intensive goods. Alright, as toys production falls, the toys industry going to free up capital to be used into the microchip industry. But the amount that is being freed up, the amount that is being supplied is going to go up only a tiny bit because toys only use small capital to begin with. So there is a great increase in the demand of capital US, but there is only a small increase in the supply of capital in China. We look at the question number 3. What is going to happen when demand increases a lot more than supply of something? Alright, the price of that something goes up, and in this case, the price of capital is nothing, but the real interest of United States is going up. Opposite to China, the toys industry is expanding while the microchip industry is contracting. As the toys industry expands, the demand of the worker is going to go up by quite a bit because toys, as we know, it require a lot of labor to produce. On the other hand, the microchip in China which is shrinking, will only be releasing a little bit of labor. So the demand for labor is going up quite a bit. The supply of labor is going up only a little bit. So next is what happens to wages of worker in China. The wages of the worker in China will be going up. Okay. Next, what will happen to real of interest rate capital in China? As toys industry expand, as I mentioned before, it is going to increase the demand of capital, but only a little bit. On the other hand, the shrinking microchip industry is going to be releasing a lot of capital. This is going to increase the supply of capital into the economy quite a bit. And then, so what will happen to the price capital in the economy? Demand increases a little bit, supply increases a whole lot. So that it means that the price of the capital will fall. In other words, the real interest rate in China will fall. Before trade, wages US higher, wages China lower. After trade, wages in US falling and wages in China rising. It means that the gap of wages between US and China will become smaller over time. Similarly, the gap between the real interest rate in the US and China will also become smaller. And if this complete the free trade, this is a very little non-transportation cost. Then free trade will actually eliminate the gaps of wages between US and China. And the gap between the real interest rate in US and China will definitely proceed to the equality in wages in US and China, same with the interest rate. Alright, this prediction of international trade equalize factor prices into country, which is known as factor price equalization theorem. Therefore, if the prediction of HO model is valid, then the free international trade will cause return to both labor and capital. The earnings of both labor and capitals are same across country, and it will be equalized both absolutely as well as relatively.
However, on the other side, there are many criticisms on HO model. They assume HO model provides unrealistic assumptions, which it makes a large numbers of simplistic assumptions, which means this model is highly abstract and ignores a number of ground realities which obstruct or encourage trade flow. Second, HO model ignores the facts that cost-price differences can arise due to several other reasons or factors. HO theory assumes equal tastes, however, economic growth leads to changes in consumers' tastes and preferences. Other than that, they stated HO is a static theory. It needs an extension in which long-term changes in factor endowments of trading countries taken into account. Therefore, Leontief paradox is developed. Leontief paradox began in 1950 where Wassily Leontief tested HO theory empirically and discovered that US was relatively well endowed with capital through his input-output analysis of international trade. It means that US should export capital-intensive goods and import labor-intensive, but it was known as Leontief paradox because his findings are opposite from what has been predicted by the theory. He found that US exports are generally more labor-intensive than the types of products that US imports. In conclusion, HO theory is still relevant because it is still binding economists' way of thinking. As you argued, you jump to think proportions between capital, labor, and perhaps technology as factors of production. Even though there are criticism on this theory, but this theory is still remain popular in international trade world. That's all and thank you.